Well, hello and welcome to this short video on Carillion and the investment diversification. So this video is just designed to give you an insight into why investment diversification is important when investing money, and in particular how we have addressed the issue of the failure and liquidation of Carillion with our clients. So just to give you some sort of background as to how diversification works, what this is describing is the spread of your investments across a range of different funds and a range of different sectors. So in our model investments at Woodruff Financial Planning, we use up to 15 different sectors depending on the risks you're taking with your investments, depending on whether you're investing for capital growth and depending on whether you're investing for income from those investments. So the idea of that is you're spreading your money around into various different areas, different geographical regions, UK, North America, Asia, Japan, different areas like that, and different investment types. So shares, company and government debt, property and cash. The general principle is the wider you spread your investments, the less likely you are to suffer catastrophic falls if something like Carillion happens within your investment portfolio. So if you take a very simple example, if you hold one investment, such as Carillion, and that investment fails, then you lose all of your money. If you spread your money around into different areas, you're less likely to lose all of your money should the worst happen to one or more of your investments. So within those different sectors, what we also do is we have a spread of investments within that individual sector. So if you take the UK share fund sector, for example, you would typically find within the fund that we select within our model investment portfolio, something between 50 and 200 holdings. So not only are you spreading around geographical and investment type within your diversification of your portfolio, you're also diversifying further within each sector. So how does that work in practice? So here's a brief example of an investment portfolio. Now you can structure this in many different ways, and different financial advisors will have a different example of how to diversify their portfolio. But you can see here on the right hand side a variety of different sectors where we invest your money. And of course, Carillion being a UK large cap company, you would expect it, if it's going to be in your investment portfolio, it would fall within this grey sector here. Now, of course, depending on the risk you're taking, depending on whether you're investing for income or capital growth, you'll have a different spread of investments here. So how does this work in practice? So if you think about holding 50 to 200 investments within each sector, and there might be up to 15 sectors within one of our model portfolios, your total holdings could be anything between 750 and 3,000. So of course you're spreading yourself nice and thin so that when something like Carillion happens in your portfolio, it's not a catastrophe. So we take this kind of thing very seriously, and when these things happen, we aim to be in touch with our clients as soon as it happens, just to reassure them that the worst isn't going to happen to their money, because they're investing significant amounts of money with us. So here's an example of an actual client portfolio. I mean, by the way, we have written to every single client this week to explain to them exactly where they fit in this. So either they have no exposure to Carillion, or where they do have exposure to Carillion, this is exactly how it works with their portfolio. And what we've done here is we've actually drilled down into every single holding that they have with us, so every single fund, and we can actually take the data on the precise holdings within those investments. So we've got the data held on each individual fund and each individual holding. So from that we can take information like what's held in this table. So for this particular client, they've got £447,000 invested with us. It turns out when we drill into the data, they only actually have one fund which is invested in Carillion. Obviously, it's the UK Large Companies Fund, and that fund held 0.08% held in Carillion at the date of this analysis. So what that equates to for this client is £36.47. So hopefully that client will look at that information. Well, it's not ideal to be losing money with a company in liquidation. Obviously, we can't avoid that. What it means is that their overall holding so the £36 compared to the 447,000 they've got invested with us equates to 0.081%. Ultimately, the worst that can happen to this client is that they lose £36, and when you put that in the context of £447,000, it's a drop in the ocean. So basically what we're reassuring you is that by properly diversifying your money, you reduce the risk of catastrophic failure in your portfolio. Now, of course, if you're an amateur investor, I suspect you'll concentrate your portfolio a lot more than what we would do as professional investors, and you run the risk of significant fluctuations in times like this when a big company fails. Okay, so let's just really recap on how we use our model portfolio. So we have a series of risk-based investments, and we use these for new investments. So if you come in as a new client with us, we will use our model as the best we can find at that particular time for the risks you're prepared to take and the risks you need to take. And we'll adjust that according to your own individual situation and your own particular circumstances. So of course, if you need capital growth, there'll be a different portfolio to if you need income. And of course, if you want to invest in particular areas, we can accommodate that too. We then review that versus the ideal quarterly and annual reviews. We have a root and branch review to say how is your current investment portfolio performing versus the ideal that we can find, and we'll make adjustments according to your needs at that time. So of course, none of the performance data that we publish on our website is guaranteed. It will vary according to a variety of different tax charges, and you always have to remember that any investing comes with risk to your capital and or income. Right, that's it. Thanks for listening, and check out our website and YouTube channel for more videos like this one.